We have asked a number of these banks and a number of these fund managers about concerns about a China slowdown, especially with issues really coming from the property sector. But I wanted to ask him more about what we're seeing as signs of waning consumer and business confidence, especially of the retail sales growing at very tepid paces, and also signs of higher youth unemployment, and also of people perhaps doing revenge saving, and whether or not that hints at more anemic growth patterns for China that might be hard to shake off. Here's what he told me, and whether or not Standard Chartered is worried about some of the more endemic and structural issues facing the Chinese consumer.
I think the environment is difficult today. So I think consumer confidence is relatively low, and international investor confidence is also relatively low. That said, there have been very substantial inflows into the bond market, and the currency has been, having been weaker over the past couple of years, has been stronger more recently. So I think on balance, the market has found a little bit of an equilibrium. But we know that the underlying source of a lot of the confidence questions is the property market. And the property market has not yet completely bottomed out. So it's been a slow grind down. There are some signs from time to time that we're seeing an increase in activity, but at the same time, it doesn't feel like we've really found a true bottom in terms of price. Now, the benefit of the way this has happened in Chinese style is happening slowly. That means confidence gets eroded over a period of time, and that's obviously not a good thing. On the other hand, there are no real problems in the banking sector. And if we look at property market bubbles that have burst in the past in other markets, it's very frequently associated with a financial crisis. And when the real economy crisis translates into a financial market crisis, it's much, much, much worse. Usually have much more significant downdrafts in GDP. And I think the Chinese have said, we'll let the market find its equilibrium, but we're not going to do that at the expense of financial stability. So I think at one level they can claim victory so far, but it's definitely undermining confidence. And why I think we're seeing these continuous small stimulus programs, monetary and fiscal, policy driven, to make sure that we don't get into really a bad spiral that it would be difficult to recover from.
Right. The stimulus, though, it's something that everybody's also anxious about in the markets. Do you think that perhaps markets have to just accept that the stimulus is probably not going to be to the level they want, and maybe that Chinese sluggishness is probably going to be something we'll have to deal with for a longer time? I
think our expectation is that the stimulus will be enough, but not excessive. And when I say not excessive, I mean the Chinese are quite aware that the first COVID stimulus, which the entire world engaged in, post-financial crisis stimulus, which the whole world engaged in, which led to significant increases in debt levels, the West has not yet gotten off the drug of stimulus, even though the economy is at full employment. Huge budget deficits in key developed economies. I think China is quite keen not to weaken themselves from a fiscal perspective. In the long run, that's going to be a good thing. In the short run, it's a bit uncomfortable.